All right, Caleb, this is your weekly chart of the NASDAQ, okay? I want you to take a look at this candlestick's low here to this candlestick's high. As we ran above, dropped lower, that is a inversion fair value gap. An old weekly low at the time of analysis during the weekend, so we have not started trading for Sunday's new week opening. So we have 1 week that we just closed. So you have to look back 1, 2, 3. There. That old weekly low is being annotated here. You would know about these lows anyway. Weekly highs and lows, that should always be a level. And just like previous highs and lows, they should be also factored in on your chart, or at least the very minimum in a notepad next to your trading area. This volume imbalance here, this volume imbalance, you'll see that it doesn't completely touch that. I'll explain that in a second. And this one here. Notice the setting in the lower right hand corner. I'm annotating the chart showing these 3 by contrast. These are weekly volume imbalances. They're potential downside objectives. We have this wick here. It doesn't look like it's attached, but I wanted to move it away to see if I can clean this little area up. And then this weekly discount wick consequent encroachment is here. So I'm looking at this wick, half of that, so drop a fib, the 50% level. That's what's been annotated there. And this one is this wick. And then we have the weekly relative equal lows. It's a sell side liquidity pool. Now with the settlement toggled again, you can see that that volume imbalance is much more cleaner. That's what these are matching in there. So which one am I using? The one that has the narrow separations and gaps, or the one that has the widest? This one here, the one that has the widest, okay? So it makes it easier to understand which one I'm doing. I'm sticking to the same logic I gave you initially. When you're looking at the higher time frame charts, that SET, that settlement price toggling option, where you can use the settlement price for your close on the candlestick, always elect to go with the one that has the wider separations between the bodies. If it has that versus something that may show no volume imbalance at all, because there's sometimes it's like that, I will always elect to use the one that shows the volume imbalances, okay? All right, moving down into a daily time frame, that weekly inversion fair value gap is transposed here, anchored to that candlestick's low there. And we have a bearish order block, and it's also the high of this fair value gap. Go back and look at the review on Friday's live stream, where I cover the trade that I took nailing the high on Thursday down into the daily volume imbalance, which is here. We don't need to look at that anymore. That's all part of the old data. I'm not showing any new week opening gaps or new day opening gaps on this chart or any of these charts. It's your task to have those included on there. I want to keep the chart pertinent to these specific levels that I'm sharing going into a new week. We have a daily volume imbalance here, and it's anchored on August 13th, 2024. Whenever you're annotating your chart, Caleb, the day that creates the candle to the right that forms a PD array, for instance, this candlestick here, that body and close compared to the next candle here, where it opens, that candle is the date that you anchor to. Just like when we do a new week opening gap, you're using the Sunday's date to label that gap for a new week opening gap. New day opening gaps are always going to be referred to the next day because we're on the East Coast of the United States. So while it's being formed at 6 p.m. New York local time, after that 1 hour break between 5 p.m. Eastern time to 6 p.m. Eastern time, the 6 p.m. is still technically inside of the date or the day of the week, but we're referring it to the date and the day name after midnight, New York local time. So in other words, it's always going to be counting tomorrow as the labeling for new day opening gap. But everything else is self-explanatory. And again, the new week opening gap here, you can see how we came down and hit that here. small little coloring outside the lines there. And now we have, this is going to be a old weekly low. That means it's last week's low. And that previous old weekly low there. Now you can label these by date. I'm going to let you have that discretion to determine how you're going to label it. You may want to use a numeric format like this, or you may have to type it all out if you want it that way. But the next one is this weekly volume imbalance down here. And I'm not adding it here, but I want to show it to you. You want to get the measurement on here. That's consequent encroachment. So kind of close to that weekly volume imbalance level. So this is your imbalance, but anchor that also with the real price level of this premium wick. It's midpoint or consequent encroachment. And then we have this wick here is essentially that low. You can test that out. Okay, it's by 1 tick or so off. So you can just eyeball that. That's what I do when I refer to wicks like this. If I see a candlestick's low, then I know that that wick's midpoint has been used here. So I look at that low as now a key sell side liquidity pool. All right, moving into a 15-minute time frame. You can see the bearish order block, bearish fair value gap high and low, bearish order block here, hitting that. This inefficiency here, I mentioned this in the live stream on non-farm payroll Friday, and I ended up making the turn in here after taking primary buy side and primary sell side, which was given during the non-farm payroll live stream. Market breaks into that weekly inversion fair value gap. Notice that the candle opens here, trades up to the top of that inversion fair value gap, breaks lower. We have a discount wick, consequent encroachment. Price on this candlestick here, open, traded up, and it failed to get back to Thursday's daily low. So we're looking at previous day's low, which is here. This is Friday's price action over here. I have the daily delineated vertically with midnight New York local time. So here's Thursday's low. So we traded through it here. All of this is non-farm payroll, which is highly manipulated. Trades up into a bearish fair value gap, which is a SIBI on the 15-minute time frame. That's the time frame we're on right now, Caleb. And then we break lower. We failed to get to Thursday's daily low here, and we didn't get up to the discount wicks consequent encroachment. So that means we're decidedly weak. Then we have also the bearish order block, which are these three consecutive up close candles. The opening price, that's the change in the state of delivery. It trades to that, breaks down. We have a discount wick, consequent encroachment, midpoint of the measurement between this candlestick's open and that candlestick's low. That's what's being measured, okay? Extend that forward. We open on this candle, trade up, and then break lower, attacking the primary sell side liquidity. Trading down into the daily volume imbalance on August 13th, 2024. You find that information on the daily chart. And then we created a SIBI here. This is a bearish fair value gap. Classification is sell side imbalance, buy side inefficiency, as labeled here. And it's anchored to what time frame? The 15-minute time frame. So when you're doing your annotations, Caleb, you need to manage them with these little tiny little reference points. Just like the W here means that it's a weekly inversion fair value gap. So it keeps your charts very organized. You'll be able to see what reference points are pertinent, and I'm going to teach you how that is important for watching institutional order flow and tracking the price delivery continuum theory. We have a wick here. It's a premium wick, so that would be a consequent encroachment level there. But because we've had this gap, this running back up into the daily volume imbalance, and then leaving that, I would never expect that mid wick to ever be traded to again, because we have this one, and then we have this one here, which is technically immediate rebalance. So immediate rebalance is we don't like to see a consequent encroachment if it's done on the basis of a wick like it does here. So that's for your notes. It'll also be more details about that in the books. But bearish fair value gap, sell side imbalance, buy side inefficiency, 15-minute time frame, breaks lower, trades to a discount wick, consequent encroachment, and a discount wick, consequent encroachment on these dates. Okay, so their daily time frame. Bearish order block, we trade up into that here. And then we have, again, premium wick consequent encouragement, which is this wick there. And then we break lower into the weekly volume imbalance. And then now that is the low of the week. So that will be factored in as a array for next week's trading, which is simply going to be previous week's low. Over here, we had the high of Thursday, which is here. You can see that anchored to that. And then Thursday's daily low here. The best or optimal shorts when you're bearish are going to form in the lower half or lower 50% of the previous day's range. That's this level here, 18,970.75, and the high of that candlestick comes in at 18,972.25. Really, really close to that, but it's only done on the basis of a wick. Notice that the bodies are staying down here towards the low end of what? That bearish fair value gap that I annotated live in the live stream on Not From Payroll. So that's indicating that it's heavy. So again, lower half of the previous day's range, when you're bearish, that's where your best shorts are going to form. 5-minute chart. All the details from the 15-minute time frame are transposed here. Now we have at the top end of that weekly inversion fair value gap, we have the first presentation of a bearish fair value gap right here. Look at the beautiful delivery here. We open, trade right up to the top of the inversion fair value gap into that first fair value gap formed between 9:30 and 10 o'clock. You can't use 9:30 as the imbalance candle, so it has to be 9:31 minimum. And the market trades aggressively lower. Here's another inversion fair value gap. It's bearish, and then we break lower. We open on this candle, trade up into the bearish order block right there, but it's also the low of the inversion fair value gap. So there's several factors there, and that's why you're seeing that sensitivity. The breaks lower, and then we have a small little gap in here. The wicks trade through the bearish 15-minute order block. See how right away the labels help you? So now when we're watching, say, for instance, a 5-minute chart, I'm looking at these levels knowing that they're on a higher time frame. So that means I'm allowing and affording price the luxury of trading through the shorter term 5-minute levels that appear here, expecting the higher time frame PD arrays, that like the 15-minute time frame here, or the daily or the weekly ones, they're going to respect those levels on the lower time frame more subordinately than looking at the lower time frame 5-minute PD arrays. The 5-minute PD arrays that form in this time frame, or in this time frame as being 5-minute, they can color outside the lines. Whereas I expect the higher time frame, 15-minute, daily, and weekly, like we see here, it just goes right to the top and it immediately breaks lower. The 15-minute time frame discount wick constant encouragement here, it trades up to it, just goes above it by a little bit, but it's really what's it doing? It's reaching into a bearish 5-minute order block, the opening price of this up close candle, and the low of this 5-minute inversion fair value gap. What makes this an inversion fair value gap? Because all the details about this supposedly failing to go higher, and then we get that confirmation that when it goes lower, when it overlaps this dropping lower, we expect that range to act as a point of shorting. So it's a premium array. And we can see that with the body. See the body staying inside that inversion fair value gap? These are all signatures, Caleb, that tell you that what you're watching in terms of a PD array, it's verifying and validating select points of reference that I'm teaching you with the PD arrays. And we have a discount wick on the 15-minute time frame. We trade through that and attack the primary sell side liquidity, digging down into the daily volume imbalance on the 13th of August. And then we have that 15-minute time frame fair value gap SIBI. And it trades up into the upper quadrant of that daily volume imbalance, that blue shaded area here. And it allows price to trade up into that and covers that tiny little gap right there that I don't want to add, but you can do it on your own chart. Then we have the market creating another bearish fair value gap here after it creates this wick. So this one here, it goes up into this 5-minute fair value gap. It could have went all the way up to the halfway point of this wick and the midpoint of this 15-minute time frame fair value gap that's labeled, as you can see here. And then markets are showing what with the bodies. The wicks are doing the damage. So while we're watching the market, say you're short up here using the first fair value gap, you could be holding this, but you can't have a stop close to this high. You got to wait for price to prove to you by the candlesticks closing. The bodies are staying well below several time frame PD arrays. So that's how we manage or have beginning foundations to managing a stop loss, or while we're tape reading and observing price, you want to look at reference points like this in past data. And when you're watching it live with me, you want to see it give these types of signatures, and you'll see how it helps you stay in a trade and you're not in a rush to jam a stop loss behind a short trade and get stopped out prematurely. Then we have a bearish order block here. Market consolidates, creates a small little minor buy side liquidity pool. It rallies up, attacks that, and trades into the bearish order block on that candlestick there. That's what you're being noted there. That's a 15-minute time frame as well. So two factors are occurring here. They're absorbing more trailed stops, and they're going into a premium array. Why would they want to do that? So they can position themselves for the next leg lower. Where's the next leg lower going to go? Right below these relative equal lows and down into that weekly volume imbalance. Market rallies up, attacks another minor buy side liquidity pool here, hits the premium wick consequent encouragement of a 15-minute time frame. See all this in here, you can't appreciate it on the 5-minute chart, but by having your labels correctly annotated, you know that if you're watching, if you're peeking at a 5-minute chart in relationship to your 1-minute chart, or you're watching the 1-minute chart, you'll have these time frame PD arrays that are anchored to a 5 or 15-minute time frame, or daily or weekly. Price is going to be much more subordinate to that in response to their repricing to them or through them, and ultimately it breaks lower here. Okay, 1-minute chart here. This is the regular trading hours. So what I'm showing you is the opening bell at 9:30. That's this price here, and the previous settlement price here using regular trading hours. We opened here, traded up, and we left the upper quadrant open. Just fell short by 1 tick. You might want to compare and contrast your price there, but it just fell short by like 1 tick there and left that portion open. But you can see the half of that gap. It opened, traded right up into it. So 70% of the time, 50% of the gap will get traded to within the first 30 minutes of trading between 9:30 a.m. to 10 a.m. Eastern time. The market breaks lower, comes right back up into mean threshold of this up close candle there, breaks lower aggressively, and all the things that we just went through. Now we're going to look at the same time frame 1 minute with electronic trading hours here. So inside that bearish fair value gap, SIBI 15-minute time frame basis, we have a small little fair value gap there. Trades up into it. Look at the bodies respecting that beautifully. Breaks. So we have a shift in market structure. Trades back up into that fair value gap there. That's an optimal trade entry there. It's a model 2022 entry also for those that have studied that on this YouTube channel. Then it breaks into that weekly inversion fair value gap here. Trades up to the high of the inversion fair value gap, and then trades back to, again, what's this? On a 5-minute chart, it's the first presented fair value gap. We work from the 15, the 5, and the 1. So if the fair value gap forms on the 5-minute chart, you don't need to be waiting for it on the 1-minute chart. So you're working from the higher time frame down. That is the price delivery continuum theory. Here it shows perfectly being delivered. Now you see this gap here and this gap. That's what you're seeing on the 1-minute chart. But if you're not referring to it in the way I'm teaching it, son, you won't see how this is all one singular candle, where on a 1-minute chart, you might expect, oh, it might want to trade up into here. It might want to trade up into this area here because that might be a bearish order block. No, because it's being subordinate to the 5-minute chart fair value gap, because that's the first presented one. So algorithmically, it reprices to that one. It need not go any higher. Breaks back down into a smaller 5-minute inversion fair value gap. You're going to want to go back through the charts here, rewinding and seeing it. But most importantly, you want to go into your own charts and create the same thing in your charts, not just use mine. It breaks to the low of the inversion fair value gap formed on the 5-minute chart. And then once we go below it, we trade back up into a bearish 5-minute order block, which again is anchored to something over here that you wouldn't see, but on the 5-minute chart, it was annotated. So as the market creates these things, I'm writing them down on a notepad, but you can't do that initially. So I want you to label your charts like this. It will feel cumbersome. It feels tedious. It feels like a lot of work for nothing. But this is how I learned to trust holding on the trades and seeing them form. Seeing this stuff repeat over and over and over again. Then you have displacement lower. We have a gap in here that was based on a 5-minute chart. It's too tight for me to annotate it. This one here is on the 1-minute chart here. So we work lower, trade up into a 1-minute fair value gap. The bodies are trading up into a discount wick on the 15-minute time frame. So if it's based on a 15-minute time frame, it's reasonable to see it trade a little bit outside the lines and not change anything. It's not disrupting anything, basically. And the market breaks lower, and that's your breakaway gap. And then we go into the daily volume imbalance on August 13th, come back up into consequent encroachment of that. We break lower. We create a 5-minute fair value gap that you can't see now on a 1-minute time frame. That's why you have to work from your higher time frame down, and you verify them with the lower time frames. How does it behave around them? The market trades through this fair value gap, but what is it doing? It's trading right back up to a bearish order block on a 1-minute chart, and it's going to the upper quadrant of that daily volume imbalance on August 13, 2024. So all of this is a fake rally that gets faded into. It breaks lower, trades the consequent encroachment of the 5-minute fair value gap, which is also a lower quadrant level on this 15-minute fair value gap. We break lower, order block. I didn't want to put too many annotations, but these are suggestions for you, Caleb. Break lower, attack the sell side, consolidate, and using the discount wick consequent encouragement of the 12th of August, 2024, trades into that, breaks lower, and then settles into a small little consolidation, making minor buy-side liquidity pool. But the downside objective, which is the discount wick consequent encouragement of August 9th, 2024, so they're daily. So that's a daily candlestick PD array. And if you look at that date on your daily chart, you'll see that wick, and that's the midpoint of that wick there. Just like this is the midpoint of the wick on the daily chart for August 12th, 2024. So half of the wick, that's consequent encouragement. These are all objectives reaching for. So it hits it first here. Then we have this little rally here, and then we finally reach down into this one right there.